Have you ever wondered what it actually takes to completely re-engineer a nation's economy? Well, today we're going deep inside Nigeria's ambitious financial overhaul to break down the huge changes they're making to reshape their future.
So let's just start with a big question that really frames this whole explainer. How in the world do you even begin to re-engineer a country's entire economic framework? This isn't just about tweaking a policy here or there. It's about rebuilding the whole system, almost from scratch.
And to answer that, our focus is squarely on Nigeria. Right now, the country is undertaking one of the most ambitious economic restructurings it's seen in a long, long time. We're going to break down exactly what that means, piece by piece. Okay, let's get into it. So here's our roadmap. First, we'll look at the rules governing the heart of the financial system. Then we'll get into the tricky macroeconomic balancing act. After that, we'll dive into the nitty-gritty of a massive tax code overhaul. And finally, we'll pull it all together to figure out what it all really means. All right, first up, governing the financial core. The best way to think about this is like laying a super strong foundation for a skyscraper. Because let's be real, if the banks, the very foundation, start to wobble, the entire economic structure could come crashing down.
And the main tool for building that foundation is something called corporate governance. It's basically the official rulebook for how a company is run. And its goal, while it sounds a bit corporate, is absolutely crucial. Build public trust and make sure everyone is playing by the same ethical rules.
Which brings us right to the problem that regulators are trying to fix. How do you make sure the banking sector, the bedrock of the whole economy, is stable, and more importantly, that people actually trust it with their money? And the solution? Well, it comes in the form of new and much stricter corporate governance guidelines from Nigeria's central bank. These kicked in on August 1, 2023. And let me tell you, these aren't just gentle suggestions. They are a direct response to financial instability in the past and a huge signal that a new era for banking is here. Now, here's what's really fascinating. It's not a one-size-fits-all approach. Check out these differences. For a regular commercial bank, the CEO's tenure is kind of flexible. But for the parent company, the big financial holding company, there's a hard stop at 10 years. This is a deliberate move to make sure no one person becomes too powerful at the top of the financial food chain. And it doesn't stop with the CEO. For deputy managing directors and executive directors at banks, their time in those top roles is now capped at 12 years. The message from the regulators is crystal clear. It's time for some new blood, new perspectives, and fresh ideas in Nigerian banking. Okay, let's move on to our second section and see how this all connects. If governance is the foundation, then managing the wider economy, well, that's like the architectural plan. And believe me, it is one heck of a balancing act. To really get this, you need to understand two key forces. Think of it like driving a car. You've got monetary policy, which is handled by the central bank. That's your accelerator and your brake, using interest rates to control inflation. Then you have fiscal policy, run by the government. That's the steering wheel, using taxes and spending to direct the economy. For a smooth ride, they absolutely have to work together. But here's the rub. In Nigeria, there's often been this issue called fiscal dominance. Basically, it means government spending has been like a powerful crosswind, making it incredibly hard for the central bank to steer. The government's spending habits were so strong, they were overwhelming what the bank was trying to do. So the central bank can't fight inflation alone if the government is pushing in the opposite direction. So why does this coordination matter so much? A concept called the Mundell-Fleming model shows us exactly why. It's like this. When Nigeria adjusts its policies, especially interest rates, it sends a signal to investors all over the globe. If that signal is good, money comes flooding in, and the currency gets stronger. If the signal is bad, money rushes out, and the currency weakens. It's a massive global dance, and every single policy move matters. So you've got your foundation, you've got your architectural plan, but how do you actually pay for all of this? And that brings us to part 3, a complete overhaul of the tax code. This is all about how you fund the whole project. The centerpiece of this whole reform is the proposed Nigeria Tax Act of 2025, and its mission is pretty simple in theory. Take the messy, tangled web of existing tax laws and combine them into one single, clear rulebook that everybody can actually understand. Think of it as a major spring cleaning for the tax code. Okay, so what does this mean for everyday people?
Well, the new structure creates a tax-free buffer for the first 800,000 Naira earned. That's a big deal for low-income earners. At the same time, it does ask those at the very top of the income ladder to chip in a little more. The bottom line, the goal is a fairer, more progressive tax system for everybody.
And for businesses, simplification is the name of the game. It comes in the form of this number, 4%. A whole bunch of separate corporate taxes and levies, things like the education tax and the police trust fund levy, are all being rolled into one single 4% flat rate development levy on profits. Much simpler.
But the reforms also get tough on companies trying to stash their profits overseas. These new CFC rules are basically like the long arm of the law. They can now reach across borders to tax the profits of Nigerian companies no matter where in the world they're being held. And this is a really big deal. By bringing in a 15% minimum tax rate for large multinational corporations, Nigeria is plugging into a global movement to make sure that huge companies pay their fair share, right here in the country where they operate. It's a real game changer.
Okay, we've talked governance, we've talked policy coordination, and we've talked taxes. So let's step back, bring it all together, and ask the big question. What does this all mean for the road ahead?
So here it is, the new economic blueprint in a nutshell. First, you've got stronger governance, with tighter rules and term limits to make the banks tougher. Second, there's a huge push for smarter policy, getting the government and the central bank on the same page. And third, simpler, fairer taxes, designed to make it easier to comply and to bring in more revenue. These three pillars, together, are the heart of this entire reform effort. Which leaves us with one final and maybe the most important question of all. The blueprint for a new Nigerian economy, it's all there, on paper. It's ambitious, it's comprehensive, it is definitely bold. But the real question is the will actually there to build it? Because the future of Nigeria's economy really does hang in the balance.